Welcome to the TAC Index AI podcast. We're the place where we blend live TAC index data, all the reports and charts, with the latest news and logistics really focusing in on air cargo.
And our mission today, as always, is to do a bit of a deep dive, wouldn't you say?
Absolutely. We want to explore how the current air cargo trends are actually shaping, well, not just logistics, but the wider macro market too.
And it's been quite a week for it. You've got air freight rates moving, central banks making decisions, even global travel patterns throwing up some surprises.
Yeah, lots to unpack. It really shows how interconnected everything is. We're basically using, TAC index, market intelligence, Fed news, passenger data.
As clues, right, to figure out the global economic pulse.
Exactly. Okay, so let's start with the latest from the TAC index. Global air freight rates, that's the Baltic Air Freight Index, the BAI00, it saw a tiny increase, 0.4%, week ending June 16th.
Just tiny.
Yeah.
But the bigger story, I think, is that year-over-year number. Still down almost 6%.
Right. And remember those hopes we had after the U.S.-China tariff suspension deal, thinking things might trend up.
Yeah, those seem to have, well, they just sort of petered out, didn't they?
They did. Why do you think that happened?
Well, connecting it up. A big factor seems to be the end of that de minimis exemption for small parcels going into the U.S.
The duty-free allowance for low-value stuff.
Exactly.
Yeah.
Taking that away really hits the e-commerce volumes that fly by air. It changes the whole dynamic.
You can see that impact. Okay, looking regionally, Asia outbound, places like Hong Kong, BAI 30 and BA 80, they saw those typical weekly dips. Vietnam, too.
Pretty standard moves there. But what's interesting are the exceptions. You mentioned Bangkok and Seoul routes to Europe.
Yeah, those are still way up compared to last year.
Which does make you wonder, what specific demand or supply factors are propping those lanes up. It's usually something specific.
Good question. Meanwhile, switching over to Europe outbound, London Heathrow, the BAI 40, that just surged, up over 24% in the week.
Wow, that's huge. Puts it way up year on year, too, then.
Yeah, a healthy 26.7% up year over year. Seems like strong demand heading to Southeast Asia, the Middle East, and the U.S. is driving that. Frankfurt, BAI 20, also saw a bit of a lift, up 3.4%.
Okay, so some strength out of Europe and North America.
Chicago, BAI 50, gained nearly 4% week on week, just barely ahead year over year, though, plus 1.3%.
And all this data, it's getting more granular, too, right, with the TAC index adding new lanes.
That's right. More lanes from Europe out and from China to new places gives us an even better view. But let's connect this air cargo pulse to the bigger economic heartbeat, the Federal Reserve.
Yeah, the Fed. They held interest rates steady this week, kept their target range at 4.25% to 4.5%.
But they definitely kept the door open for cuts later this year, didn't they?
Oh, absolutely. They're just being cautious, it seems, waiting for maybe the labor market to soften a bit more or clearer signs that tariff price hikes won't be too bad.
Is it just the labor market, though, or other worries?
Well, it's not just labor. There's this interesting point from economist Neil Dutta. He's suggesting tariffs might be causing more of a margin squeeze on businesses.
Meaning it hurts company profits more than it drives up consumer prices.
Exactly. Which kind of paradoxically could actually lead to higher unemployment if businesses cut back. And we are seeing maybe some early signs of softness in labor, like extended unemployment benefits hitting a near 3-year high.
That's a tricky balancing act for the Fed, especially with, geopolitical risks bubbling away, the Middle East conflict potentially pushing energy prices back up.
Right, another potential supply shock they have to factor in. Lots of uncertainty.
Okay, let's shift gears a bit. Something surprising happening with transatlantic air travel. The fares.
Yeah, this is really interesting. Fares have basically dropped back to pre-pandemic levels.
Yeah?
Think summer round trips, U.S. to Europe, down 10% from last year, averaging, just over $800?
Right around $817, which is pretty much bang on 2019 prices. So what's going on? Why the drop?
Well, it seems a key reason is fewer Western Europeans are flying to the U.S.
Fewer Europeans coming this way. Why is that?
Could be a mix of things. Concerns about border controls, maybe certain U.S. policies, plus the dollar is stronger, making it more expensive for them.
Do we have numbers on that?
Yeah, like in May, travel from Denmark was down 20%, Germany down 19%. Overall inbound bookings to the U.S. for July are looking down about 13% year over year.
Okay, so that puts pressure on the airlines, especially the European ones like Air France, KLM, Lufthansa.
Definitely. They're already dealing with higher labor costs, oil prices, disruption from the Middle East conflicts. This adds to it.
But there's a flip side, right?
There is. U.S. travelers heading to Europe are still going strong. That helps offset the decline for airlines, especially U.S. carriers like United and Delta, One airline even said 80% of its long-haul international demand starts in the U.S.
So bringing it all together, these pieces, the air cargo rates from TAC index, the Fed's cautious stance, these shifts in travel, they really paint a picture of a global market that's, well, constantly adjusting.
Absolutely. Tariffs, geopolitics, they send ripples everywhere.
And the air cargo sector, it's more than just moving boxes, isn't it? It's like a real-time reflection of the wider economy's pulse.
It truly is. Which leads to a thought for you, our listeners. As businesses keep navigating these margin squeezes and we see consumer behavior changing, what other surprising connections might pop up, between logistics and the macro market in the coming months?
And how might those connections shape the next big shifts in global trade? Something to think about.